Hi, welcome. This is Cordant's market update for June 11th, 2020. Just a reminder, we'd love your feedback, your comments, anything we can do to make these things better and more useful. You can either reply to the email that you receive this or leave a comment on YouTube. These get posted there, and I believe you can leave a comment there as well. So as we are through this period where we can't get together face to face, we're trying out a few different ways to communicate. So we'd love to hear how useful it is to you and anything we can do to make it better and ideally answer your questions in this format. So today we're going to take a look at all-time highs. The market before the last 3 days was getting close to its all-time highs, back to even for the year certainly. And so what does that mean going forward? How concerned should we be about that? And we're starting to get some questions there. We want to take a look at the economic data versus what the market is doing, and how can we basically square those two things? And then really quickly check in on factors. We're talking about small companies versus large companies, or value stocks versus growth stocks, something we've covered previously here, and we want to check in that space as well. So let's get into it. So as I mentioned, other than the last 3 days where we saw the market sell off, and today it certainly is sold off, the market was getting close to where it was back in February, an all-time high. We had the 34% drop, and we're up about 37% since then. Obviously off some in the last few days. That's where we are. In terms of how normal is the drop, a pretty normal drop. So your typical bear market drops 35%. We were 34% down at the bottom. And then the rally, again, we're 37% up. It's average to be up 47% over the first year. Now, the thing that's a little bit different is how quickly, we've bounced back from the bottom. And that would be the difference, both in terms of how quickly we declined and then how quickly we rebounded. But with the market, again, at the beginning of the week, getting close to the all-time high, starting to get some questions around, what does that mean? Should we be more careful at all-time highs and things like that? And what I would say, and we're going to walk through some data and walk through an example, but what I would say just is we rebalanced in March into stocks as the market sold off, and as things continue to rally on the upside, we probably, if things kept going up, would need to rebalance out of stocks, basically increase the bond exposure. So obviously, as things have come back here in the last couple of days, we're more in line with where we want to be in terms of targets. But if the market kept rallying in the next couple of weeks, you'd probably actually see us do some rebalancing to get the equity exposure back in line with targets there. So that's just kind of what we would do as the market declines and rebounds. But what does it mean all-time highs? What does the data say? Should we be more nervous, more careful at those periods? And again, the way we're going to manage it is more from a risk perspective. What is the allocation we want? And as the markets go up, are we overweight or underweight, and rebalancing accordingly? But just in terms of where the markets are, following all-time highs, we're looking at some data back to 1915. And what you see, 1 year, 3 years, 5 years later is the data here. 1 year, on average, even at all-time highs, the markets are up about 9% over the next year. 70% of the time they're up. And that's pretty comparable to what you would expect basically just in any market at any point. On average, the markets are up 10, 11% on an average year, and it's up about 7 out of 10 years. So not a huge difference in terms of if you're at an all-time high or investing at an all-time high, what you'd expect going forward. Now, this data is from Ben Carlson, and he ran a really interesting kind of thought experiment here. He said, meet Bob, the world's worst market timer. And Bob started his career in 1970. He saved $2,000 a year. And the thing about Bob, though, is he was very unlucky. He only invested his money into the stock market at the market peaks. So he saved his money for basically 3 years. By December of 72, he had $6,000 saved up. He put it into the market only to see the market crash 48%. He was so nervous, that $2,000 that he was saving, he just basically put it in the bank, didn't invest it until he worked up the courage finally in August of 1987 to put all that money he saved, the $46,000, into the market. subsequently crashed 34%. Now, the important thing to remember about Bob, or this example, is that the $6,000 or the $46,000 that he invested, he didn't touch it. He was nervous about pulling it out too, because he was nervous about making a bad decision there. And so he left that money invested, but anything new he was saving, he didn't put it into the market until, again, December 1999, worst timing, peak of the tech bubble. Put more money in only to see it crash by almost 50%. And then again, in the global financial crisis, did the same thing. So clearly, very bad luck here, and the world's worst market timer for sure. However, what does that look like? So he invested $184,000 into the market, basically through savings. That money ended up being worth, even with this terrible luck, $1.1 million. So this is kind of the proof that even if you got really terrible timing, the equity market is kind of the growth piece of the portfolio, and over time, things do grow, companies grow, valuations grow, and these things tend to make money. Now, clearly, not as good as it could have been. If you look at just a simple dollar cost averaging strategy where he's putting that $2,000 in every year, no matter what, he ends up with $2.3 million. So certainly cost himself some money with this horrible market timing strategy. But kind of the point is, even if you do that, if you're unlucky enough to only invest at market peaks, it's still better than putting the money under the mattress, essentially. So thought that was an interesting way to look at market peaks and through the lens of some data, and also just this thought experiment here. Okay, we want to look at the economy versus the market, and what are we paying attention to there? First thing is, again, from an economic perspective, what do things look like as we open back up? What are the health ramifications going forward of the coronavirus? Looking at a bunch of data here, one of the things that I think is driving the market this week is, as we've opened back up, are we going to see another spike in cases, kind of a wave 2, as they call it? And if you look at the national data, which are the two big charts here, in terms of the number of cases, no huge spike across the country, but obviously that could be pulled down by a big state like New York, who's done a good job of limiting the number of cases. And then on the death side of the equation, seems to be trending down. I think the thing that people are paying attention to, are individual states that have opened back up or never been super strict about quarantine. Texas, rising cases, Florida and Arizona would be 3 examples. But that's certainly something worth paying attention to. Obviously, if to the extent that we don't have this contained, it means bad things for the economy going forward. In terms of some economic data, and again, this is where we get to that question of how do we have 2 million people still filing for unemployment and the market is going up? And so I think there's a couple things to consider, to remember here. First is what matters is kind of the trajectory. So we're trending down, and then better or worse than expectations. So even though we've got 2 million people or around that filing for initial unemployment claims, and that compares to 200,000 at the beginning of the year, if that's better than expectations, then it might actually mean a good thing for the economy. Other thing to consider here is these claims tend to peak 3 to 6 months before a recession ends. And so the fact that they're trending down is a good sign as well. Other thing to remember here is the market is looking out into the future, whereas the economic data is today what's happening. And so this kind of bears out. You can see that in a couple scatter plots here. So we're looking at S&P 500 returns versus GDP growth in this year, and then in next year, the following year. What you see is there's really no relation to what the market does this year versus what's the economic data this year. That's the chart here on the left. You basically see a flat line, kind of random scatter plot there. Over here, if you could somehow know what GDP was going to be next year, that's actually going to be much more predictive or indicative of where the market's going to be next year. So you see this line sloping upward. If you knew 2021 was going to have really good GDP growth, that's probably more indicative of what the returns in this year would actually be. In terms of GDP forecasts, again, these are forecasts, take them with a grain of salt, but what I thought was interesting is kind of comparing what the forecasts were back in April to where they are today. Haven't changed a whole lot, but they have basically shifted out. So what you see is predictions for Q2, Q3, and Q4, all worse right now than they were back in April. And then you see, starting in Q1 of next year, and then for the years, better next year. So if you map that back to the scatter plot, I guess that's kind of proof point to, yeah, the market kind of is making sense to rally. On the flip side, obviously this is something worth paying attention to the extent that these things keep getting pushed out, and that's maybe part of what the market's responding to this week. That's obviously not as good for the economy nor for the markets long term. So one thing we're paying attention to, but I think kind of the big picture here is you can't predict, and it's worth looking at some of the data, positioning accordingly, and making sure, most importantly, your risk is in line with where you want to be. All right, just really quick to touch on factors. We're looking at basically, when we say factors, we're talking about value stocks versus growth stocks, or small company stocks versus large company stocks primarily. We've looked at this data before, but essentially going back across other bear markets, how have some of these things done in history? And what you find is, 1 year, 3 years, 5 years later, you want to be invested in this way, or on average, it's a better way to invest in these periods. You would expect a positive premium for these factors across any kind of at any point in the market, but historically, after a bear market, they've done pretty well as well. So what I wanted to check in on is just since the bottom, March 20th, how have some of these done? So we're looking at data through the 8th, earlier this week is when I pulled the data, and you can see across U.S., both large and small, international and emerging, value has outperformed index. So in the U.S. large, it would be U.S. value stocks versus the S&P 500, for example. So they have outperformed. Now, obviously, they were hit pretty hard in the drop. There's a ways to go, but this is something we're paying attention to. How has value done since the bottom? Is it matching up to historically how we would expect it to do? So that's it for today. Again, hopefully this was helpful. Let us know your feedback, what other questions you have, and we'll see you next time. Thanks.